The United States debt crisis, a friendly but serious analysis. 1. The debt problem. The United States owes $37.5 trillion. That's more than $100,000 for every American, including newborns. Here's the kicker. The government now spends more on interest payments than on the entire military. Think about that. The strongest army in the world is cheaper than Uncle Sam's credit card bill. So what does that actually mean? It means the government is borrowing money just to pay interest on what it already borrowed. That looks less like fiscal management and more like a Ponzi scheme. Footnote. The U.S. debt is so high that interest payments now surpass defense spending. 2. The household analogy. Imagine you earn $4,000 a month but spend $6,000. Each month you add $2,000 to your credit card and pay $900 just in interest. If this were your friend, you'd tell them to stop spending or get a second job. The U.S. government is doing the same thing, just with trillions instead of thousands. It collects $4 trillion in taxes, spends $6 trillion, and pays nearly $900 billion in annual interest. The math doesn't work. Footnote. A household budget analogy makes the U.S. deficit problem easy to grasp. 3. The hidden tax. Cutting defense? Political suicide. Cutting Social Security? Impossible. That leaves one option: printing money. Printing doesn't erase debt, it devalues the dollar. Inflation is just a sneaky tax that no one votes for. Example. A saver with $500,000 in CDs watched inflation eat away $30,000 of value in 1 year. You don't see the loss on a statement. But your money buys less? Quiet, invisible, and brutal. Footnote. Inflation reduces purchasing power and acts as an unapproved tax. 4. What smart money does. Institutions, the so-called smart money, see the writing on the wall. Hedge funds, billionaires, and family offices are shifting. Ray Dalio warns of worse than a recession. Jeremy Grantham talks about a 70% chance of a market collapse. Paul Tudor Jones says move toward gold and Bitcoin. They aren't waiting to be the last ones holding the bag. They know when to sell. That's their edge. Footnote. Institutional investors are repositioning toward cash, bonds, and alternative assets. 5. Inflation winners and losers. So what does that actually mean? Inflation makes the rich richer and the salary worker poorer. Asset owners, stocks, real estate, gold, gain 20% to 25% in a year. Salary workers get a 3% raise and fall behind. The gap widens year after year. A nice dinner that cost $300 a few years ago now costs $1,000. Not because the food is better. Because the wealthy don't blink at higher prices. Footnote. Inflation widens the wealth gap by favoring asset owners over wage earners. 6. Two choices. There are only two paths. One is to demand redistribution, which history shows rarely ends well. Look at North Korea's nighttime satellite photo for proof. The other is to become asset rich. That doesn't mean buying mansions tomorrow. It means learning money management. And here's the truth. Money management is a skill. Like driving, swimming, or cooking. You can learn it with rules and a decent coach. Without it, every crash is a disaster. With it, every crash is an opportunity. Footnote. Wealth resilience comes from money management skills, not luck. 7. Practical actions. Here's what institutions do. Build liquidity. Review your holdings. Hold quality assets that can survive a downturn. Hedge with gold or a slice of crypto. Shift gradually from risky growth to stable quality. And, most importantly, be patient. Market cycles flip from euphoria to panic. The winners are contrarians who buy when others are scared and sell when others are greedy. Footnote. Long-term discipline and patience are the investor's true weapons. 8. Final word. Inflation is good for governments drowning in debt and asset owners who can wait it out. It's bad for wage earners who see their paychecks lose value. So the choice is simple. Stay a salary man and sink slowly. Or learn the rules of asset ownership and play the game on your own terms. Crashes will come. The only question is whether you'll be ready. Footnote. Financial independence requires shifting from wage dependence to asset ownership.